Hi, this is Proact Sam. Welcome to this episode of the Living Working Abroad show, where we're discussing current affairs, current events for expats living and working abroad, and changes that you can make to your affairs to reduce the amount of tax that you and your family will pay across border and down generations going forward. There's a lot going on in the world at the moment, and we're very mindful of that. Unfortunately, it is the Happy New Year time, 25th of March, traditional New Year in European countries. It changed 250 years ago to the Christmas time, but it remains a major celebration, the Easter festival across all the religions, plus the start of the tax year for countries like the UK. But it's also start the tax return season for countries with a calendar tax year. So if you are living and working abroad in Portugal or Cyprus or another jurisdiction with a calendar year tax year, then it's time to start filing those returns and get those annual returns in as soon as possible to make sure that your affairs are up to date. And this is what Expat do for people living and working abroad. If you're relocating, if you've got multiple sources of income from property rental, overseas earnings, or pensions from different countries, different places, and investments around the world, this is where Proact specialise in helping and guide you living and working abroad. We offer free consultant reviews to all new contacts and existing clients on a regular basis, and you can book that online at proactpartnership.com. Contact us, or just contact the team on our new international telephone number, which will come up on the screen, hopefully. Last week we were discussing the best ways to die, and I came up with a couple of ideas about the best way to die. Maybe to pay for your funeral with a cheque that bounces, or to bank transfer all the money out of the remaining money out of your estate the day before you die as well. Many of the tales that we had, you refer to our link in the show notes to go along and read the best way to die concept, to organise your affairs and to be planned ahead and to do it which works for you and your family. And inevitably that involves making a will, and for a number of different reasons. For example, if you're a UK expat, domicile rules have changed, but you've still got this British citizenship that ties you to inheritance tax in the UK for at least 10 years and up to 20 years. Inheritance tax is 40% of your worldwide assets. So whether you've got property or business or investments in the Middle East, in Portugal, Spain, USA, Cyprus, or Netherlands, anywhere around the world, those assets come under UK inheritance tax at 40%. It's a flat rate tax. There is an allowance, but everything else is at 40%. And if you do nothing, you pay the maximum rate. Your children will pay the maximum rate. You cannot build up the wealth and pass it down to your children, because the government are going to take at least half of it, almost half of it at the 40%. The way you can plan ahead to avoid the cost and delay of probate, to avoid the cost and delay of inheritance tax, is to make gifts and use the allowances, but you can't do that when you die. You can do it just before you die if you give all your cash away, but apart from that, you need to plan ahead. Whether it's a 7-year rule, the 3-year rule, the 5-year rule, whatever, we plan ahead, and this is what we do. So if you plan your funeral, if you plan your death, then you need to be making a will, but thinking about inheritance tax and how that's going to affect your spouse and your children and your grandchildren down the generations. Preserve your wealth. It can be a great thing to do. So in the UK, you can have an allowance. A couple can have allowance, maybe potentially up to £1 million if you've got a residential property handing down. But still, there's catches and there's caveats, and there's ways for the UK to take that wealth away from you and go and spend it on something else. So a good way to die is to make a good will, to plan your inheritances. Better still, create a family trust for your business, for your property, for your assets that protect you in time, across border and down generations. For more information and guidance, contact us at proactpartnership.com and make inheritance tax an optional tax for your family. And go back to our article, Good Ways to Die. If you've got any good ideas of what you want to do, leave your comments on our website, and the link to the article and the blog is in the show notes down below. If you do get wealthy and you've got a government that wants to tax you, they're going to come up with a new tax. The UK have not yet introduced a wealth tax. Many other countries around the world are doing this as an extra way to get extra money off people. If you've got a government that's desperate to tax people, then what they do is they introduce a mansion tax. So if anybody has built wealth in a property, they can charge them additional tax each year. And they make it look a bit different because the local council is going to collect it, but it's actually still going to the central government for them to tax you and tax the wealth of your property estate while you're alive. Obviously, you can see already, you tax something more, the value will go down, the activity will go down. Tax smoking, less people smoke. Tax mansion taxes, the property prices will fall as well. So people in the UK are suffering from this, but if the tax revenues fall, then the UK could well be introducing a wealth tax. A wealth tax could be a flat rate tax on all your income. You need to consider that and how the UK might apply that in the UK and around the world. And again, you can protect your wealth by gifting, by protecting it in a family business and the family trust for your assets around the world. For more information and guidance, contact us at proactpartnership.com. It's a worrying time for people that have relocated overseas to the Middle East. Great tax advantages, a more expensive lifestyle, more dynamic, but with no taxes, it makes it a very attractive proposition until it starts raining on your parade. Unfortunately, the conflict that's going on, it's short-term in a way, but it's still there and it's still affecting people. And it's something you need to consider. Many people are asking us, what if I flee the Middle East and the bombing and go back to the UK? Again, we covered this recently last time. The advice is still, it doesn't matter what the reason is. If you want to be non-resident from the UK for your worldwide income, wherever that's earned in Kuwait, Bahrain, Oman, UAE, Saudi Arabia, if you want to be that to be exempt from UK tax, you have to be non-resident. You have to qualify as non-resident. Now, while the war in the Middle East, it is an extreme, exceptional circumstance for certain matters, you can't use it as a reason to claim exemption and continue non-residence in the UK. In my advice, in my opinion, it didn't stand up in the COVID times. There's less likely it can stand up now because you could still remain non-resident in the UK but live in another jurisdiction. So you could live in, or you could travel around the world. You can go to many places which are relatively safe at the moment, where there isn't conflict, there isn't a war zone, and therefore remain non-resident to the UK. Isle of Man, GeSY, Guernsey, Republic of Ireland are all not part of the UK for tax residents, but Norway, Portugal, the Caribbean, Belize, USA, again, not part of the UK. Therefore, you can have a short holiday or business trip up to 90 days in those locations without visa or tax complications. So it's a difficult time. The benefits of not paying tax in UAE and the Middle East are being tested at the moment. That's part of the conflict that's going on. We hope that that's resolved as quickly as possible. We hope that everybody stays safe and their families stay safe. But for help and advice on days and guidance, living and working abroad during a period of conflict, advice on how to flee a war zone but not be fleeced for tax, contact us at proactpartnership.com. We put a bit of a review on the recent budget statement. So the UK always used to have a spring budget statement, and now it's definitely moved to the end of the year. The good news about an autumn statement at the end of the calendar year is it gives the technology, the tax office, time to amend the laws and get everything in place for the start of the new tax year. Based around the end of March. Yes, it's the 5th of April. Again, we cover the history of that and the conflict between the Julius Caesar and the Gregorian calendar that led to the 11 days difference between 25th of March, 5th of April. You can see that in our other events at our website and Live and Work Abroad show, using the links in the show notes below. So we've got a November budget, and it's absolutely quite bizarre what they're doing. So there's no particular tax increases announced this time, not least because there's general big elections coming up in the UK in the next month or so. But one thing of note for me is that you can't make it up. If you increase taxes, then it's going to have an impact. So you increase tax on cigarettes, for example, as I said earlier, so that smoking goes down. If you increase tax on diesel or fossil fuels, then consumption will go down. We understand that. You give subsidies to electric car buyers, then electric car subscription goes up. So the European Union and the UK are busy giving electric car subscriptions to people to buy an electric car, and they're buying a Chinese electric car at the expense of the existing European petrol and diesel based industries. They're so big and cumbersome they haven't been able to change over to the new electric modes quickly enough. Well, the Chinese have built them from scratch and now taking over the market using EU taxpayers' money to subsidise those purchases. These are the idiosyncrasies of budgets and why they make so much nonsense. Rachel Reeves' first UK budget in the UK increased not income tax but tax on employers, the national insurance that they pay. So it's not something that the employees see, but the employer has to pay it. And the employee sees it when he gets made redundant, when he doesn't get a pay rise, when he gets laid off. So unemployment is rising. You increase the tax on employment goes down, and unemployment goes up. And this is where we are. And so you can't make it up about a tax and spend government. If they increase taxes and then the consequence of their tax increase, i.e. unemployment goes up, they then announce a subsidy for employers to employ people that are unemployed. So using taxpayers' money or the employer's tax that they receive to subsidise those employers for the extra tax that they have to pay for that employment. It's a circular nature of taxation. There's an optimum level of taxation. Everybody wants to pay for the community, for the streets and the lighting and the community and getting things done, for the armed forces and for streets to work on. But once you go beyond that fair level of tax, it becomes a negative return. people leave the country, people make tax plans to pay less tax. We're very happy to help you undertake a tax saving plan regime to save inheritance tax, capital gains tax, income tax and savings tax, and we can help with that if you contact us at proactpartnership.com. But at the end of the day, a government, an honest government, could tax fairly and keep their people happy to pay a fair amount of tax on the income that they earn, and then you wouldn't get the subsidies that have to be issued to employers to repair the damage. So meanwhile, the opportunity is consider working as a digital nomad. If your employer can't afford to employ you in the UK, then potentially can afford to employ you while you're working remotely. So even though a UK citizen might not be able to work freely in the EU or another jurisdiction because they can't get a work permit in that country, or they might not want to work in the Middle East, what they could do is you could work in another jurisdiction. So if you wanted to live in Cyprus, which is relatively safe, forces bases protected, Turkey is a NATO member that oversees the north of the island. There's a lot of backwards and forwards about Cyprus being a NATO member. Cyprus isn't a NATO member, but it's an associate member. That happened when Trump came in power. He upgraded Cyprus to an associate member of NATO, not a full member, but they are in the game and worthy protection. And again, we've raised this before. There's the UK military bases, but there's also a military base at the civil Paphos airport. It was originally a military base with Greek, Israeli, and American warplanes and service personnel there on a time-to-time basis. So consider how you want to live and work abroad, and if you want to relocate overseas or change your location to protect your non-resident status, or find a new place to work which is digitally remote from the UK, that you can live and work there for a UK employer, but without them having the extra expense to cut your salary or cut your job altogether. This could be a best of both worlds. For more information for employers and employees to working as a digital nomad around the world, contact us at proactpartnership.com. I'd like to think it would be a happy new year, a happy new tax year coming up on the 25th of March, the end of March, 5th of April, for different countries around the world. But it will be a very, very interesting time for many, I believe. What we are looking forward to is the introduction of Making Tax Digital. Now, depending upon your view, this will be a very efficient modern way of doing tax going forward, or it will just be a complete and utter nightmare. HMRC have been trying to introduce Making Tax Digital for a number of years now, and it's failed miserably. And we are where we are today. So from April 2026, Making Tax Digital, it comes into effect for everybody that qualifies for it. So there's still an annual return basis for people that ask to do a return or have got other income or taxes to declare. But essentially, Making Tax Digital introduces the equivalent of a VAT quarterly tax regime for people in the UK that are tax residents, self-employed, or property rental, own a property rental portfolio in the UK. So those people having to real-time report their income and capital on a quarterly basis and then submit that into the revenue every quarter. They may still need to do an annual return depending upon what their portfolio of employed income, capital gains, earned income, rental income, overseas income, dividends, etc. But essentially, Make Your Tax Digital is for anybody who is self-employed or a property rental owner in the UK over certain levels of income. They're going to have to do the quarterly reporting as if they're doing VAT reporting in the UK. So it's a big jump and it's a big leap. Making Tax Digital is a different way of working. You may still be able to use as an expat the annual return, but it is a change, and it will be forced through and it will work despite the teething problems. So to register, to engage, to get yourself working in the system, and for advice and support in doing that as an expat tax agent, contact us at proactpartnership.com. We've talked recently about the changes of Cyprus tax for 2026. So what we said is that tax returns are becoming mandatory for everybody going forward. Therefore, if you lived in Cyprus for 1 year or for 20 years, now is the time to get yourself tax registered and tax organised. You may not have a tax registration already, because up until this year, anybody with an income under 20,000 didn't need to do a tax return. So if you've got no income to pay, you didn't need to do that. But in 2019, the Cypriots introduced what they call a GeSY tax, a health tax. It doesn't qualify for their health system, but for the health service in Cyprus, that's done differently. But what it does do is it raises the additional revenue for the Cyprus government's state health system, which came into being around about 2015. So it's a tax to pay for that, and it is payable at a flat rate on all your worldwide income. So there are very many low tax rates in Cyprus. You can pay no tax on unremitted income or dividends, 5% on pensions, or dividends. It can be 0% dividends. So you can have very, very, very low tax rates. However, the health tax is still payable if you're a Cyprus tax resident, and it doesn't qualify you for the state health system, but it is a tax to pay. So that is why they've introduced the legislation to say everybody needs to do a tax return. And in a way, it's a separate version of Make Your Tax Digital to get real-time information on what everybody is doing in terms of their income coming from property rental income, overseas income, dividend income, and earned income. It's very easy in a pay-as-you-earn system to see what somebody's earning. What it's trying to do is to take the investment portfolio, the overseas income, the property rental income, for all these different people, and get that on the same basis of record keeping for the tax office, so they can maximise the returns. And for Cyprus, what they want is they want everybody to pay the health tax on their worldwide income. So hence, everybody has to report. Doesn't matter if your income is 5,000 or 5 million. If your income is between, if your age is between 25 and 70, you have to do a tax return in Cyprus. If you haven't done one in the past and you're a tax resident, and you're resident in Cyprus, you need to get tax registered. Proact can assist you with that. Contact us at proactpartnership.com. If you need a return, we can advise you when you need to do that and how you need to do it. If you've got a property and you sold property in the past, you already had to do a tax return. The bizarre thing about the Cypriot system is that they haven't required people to do tax returns, but in the past, if you sold property or died, you've then had to do 5 years worth of retrospective tax returns. Well, that's going to end now because everyone's got to do those tax returns going forward. So for more information and guidance on Cyprus tax registration returns and getting ready for the annual returns in Cyprus, contact us at proactpartnership.com and our Cyprus office will be able to help you. And don't forget, in Cyprus there is no inheritance tax. There's no capital gains tax on overseas capital gains. There's only a capital gains tax on Cyprus real estate, and there's no dividend tax for expats. Cyprus is a great place to be a digital remote working nomad, or just to relocate to live on in pensions or investment, or manage your business from abroad using a family trust or family a trust company in Cyprus, where you can pay little or no tax, and avoid the inheritance tax of 40% from the UK. For more information and guidance, contact us at proactpartnership.com. What I wanted to do is just clarify finally about Cyprus a bit more about this health tax. So what I was saying earlier is that the health tax doesn't qualify you for state healthcare in Cyprus. There's a couple of things you can do. Cyprus is part of the reciprocal social insurance agreement with the EU, which includes Cyprus. This reciprocal social insurance agreement with the UK also includes USA, Canada, Turkey, Caribbean countries, Israel, New Zealand, Yugoslavia, all the Yugoslavian states, and the Channel Islands. So many of these countries still have the same reciprocal UK healthcare treatment that you have. You don't see this in the Middle East, for example. So you have to have private medical care, which it's no bad thing. If that's what you want to do, go down that route. But if you want to preserve a state pension legacy, then if you're in a reciprocal country, then those state benefits, state healthcare benefits, are transferable to that new location. Okay, so having that in mind, okay, how do you access that? There's a transfer form called an S1. Now, if you're a state pensioner, you'll want to take this S1 form as a state pensioner and register it in your new country. And if you register that in Cyprus, for example, that will then qualify you for the state health system. In effect, the charges are made between the two countries. So UK Cypriots in Cyprus have their healthcare paid for by the UK, and Cypriots in the UK have their healthcare paid for by Cyprus. That's a reciprocal agreement between the governments, not your problem. What you need to do is protect yourself and your family by registering yourself to qualify for that state healthcare system when you're living and working abroad in a reciprocal country. But it's not only state pensioners that qualify to be issued as an S1. If you're a digital nomad and you're working temporarily abroad for up to 2 years outside the UK, and your current contributions are up to date in that country, or in any other country, if you're living and working abroad in Cyprus and you go to live and work in another country, again, the reciprocal treaty works that way. So you can take your S1 into your new country, be that Canada, USA, Caribbean, Israel, Turkey, New Zealand, Yugoslavia states, or the Channel Islands. So all these places are available to you. It doesn't help with people from the Middle East trying to get away from the trouble at the moment. But obviously, if you go back into these countries, then the private healthcare can be supported by your state pension qualification. So with Cyprus, with the S1 registered, if you're a digital remote worker, you can get the S1 for up to 2 years, and that will give you the state healthcare. So even if you're doing a digital remote contract, you won't pay social insurance in Cyprus, but what you will do is you'll pay income tax as a tax resident, and it's the S1 form that gives you the state healthcare and the entitlement to benefits if something goes wrong. In addition to that, that just lasts for 2 years. It depends on the contract length that you've got, so we can renew it, we can get it renewed for you. If you want help and guidance as a digital nomad to get an S1 coverage in Cyprus or your reciprocal country of tax residence, contact us at proactpartnership.com. But the other interesting thing that you need to understand is that, go back to Cyprus, that the health tax in Cyprus is chargeable on your worldwide income if you've got a state pension. Your worldwide income if you're a taxpayer in Cyprus, unless you've got an S1 issued for your work around the world. So if you've got a state pension and you get an S1 issued and you're living and working abroad in Cyprus, the GeSY health tax for the state healthcare, that tax is abolished, so you don't have to pay that. I wish I said that clearly, or more clearly. So I'll just repeat it one more time. If a state pensioner from an EU or a reciprocal state comes to live in Cyprus, registers their S1 from their home country in Cyprus, they do not have to pay GeSY tax on their worldwide income at all, whether it's their pensions, investment, rental, business, or dividend income. That's completely abolished. If you're a digital nomad working with an S1, you still have to pay it. The digital nomads that don't pay it, okay? The S1 is a temporary contract that allows you to come and go, and you need to work out what your social insurance agreement is going to be for that. So you haven't necessarily, you may still be paying in your home country, and therefore you qualify in a different way for that. Proact are experts for guiding people who want their state healthcare protection kept in place under the reciprocal social insurance agreement. By maintaining national insurance or social insurance contribution, you continue to qualify for state pension in your country of tax residence over the years. In the UK, it's 35 years worth of national insurance or social insurance contributions. Each year's contribution, it can be from any of the countries in which you work. So if you do 5-year shifts in 10 different countries, you've still got 50 years worth of contributions. And all that helps build up your state pension entitlement if that and your benefits if that's relevant to you, and qualifies you for the state healthcare. The final thing that the S1 does for a state pensioner that's living and working abroad in Cyprus or another reciprocal EU country, if you've got a S1 registered in that overseas country, your state pension will continue to be index linked. So if you go to a country that is not got a reciprocal social insurance agreement with the UK expat state pension will not be index linked. So if it's in Cyprus or Turkey or Portugal, it would be index linked. But in other countries, it's not. Okay. So New Zealand has got a reciprocal social insurance agreement, but Australia does not. So those are the interesting challenges that you've got. For more information about relocating overseas and utilising and maintaining your social and national insurance entitlements and benefits today for state healthcare, and in the long run for family benefits, welfare benefits, and for state pensions, contact us at proactpartnership.com. Thanks a lot for listening. We've talked about a few things today. We've talked about budget issues in the UK and how the tax creep goes on to keep increasing tax to detriment of employment and helping people leave and relocate overseas. Making tax digital is going to double down for self-employed and property rental people in the UK, and progressively getting down to making a quarterly tax return a requirement of everybody earning over 20,000 a year in those categories. So it's the second version of the VAT return. But other countries do require you to do a tax return as well to report what you're earning. If you give an accurate report, then everything will be okay. But if you know help and guidance in registering those, you can contact us at proactpartnership.com. If you plan ahead, you can plan ahead with a family and a business to protect your family, to avoid inheritance tax, to avoid the cost of delay of probate. That's a good way to die when that time is going to come. So again, if you want help and guidance of planning your wealth, property, investment, pensions, and business across border and down generations, you can contact us at proactpartnership.com. Thanks a lot for listening, and we'll see you next time.